What's up, guys? This is Carter Thomas with Coin Mastery TV. Make sure you hit that subscribe button and the notification bell so we can get rocking and rolling. Right down below that video, just hit that thing. All right, great stuff. Today we're talking a little bit about Bitcoin and the prices, but we're going to talk a little bit about macro global finance world forces, specifically around the deflationary dollar, I should say the inflationary dollar, deflationary price, decreasing price, as it relates to gold, what that means from a macro standpoint, potentially what that means for crypto, talk about the implications of that into the crypto market, which is kind of an uncharted territory. Then I want to talk about market cap and how market cap is calculated currently, which I think is a very, very interesting thing to talk about. And then end, I should say, with a tidbit, a really good tweet I saw, which was a summary of a live Periscope that Naval Ravikant did. So jumping in right here to Bitcoin, there's really not a lot of new news here. We are seeing a bit of intraday action, I guess is the word. You can see that it's bouncing off of this support here, or I should say this resistance, coming back down. We're really just kind of floating around in this world. A really good time to be patient. And what we're all waiting for, as we've talked about, is this volume. So when you scroll out to the 1 day, and you can see how this huge volume spike brought the price down. And now this kind of new level of volume is maintaining this level right here. We just need more volume. And that volume is going to come from more people signing up for Coinbase all the way to more banks deciding to get in. But no matter what, we just need more volume in the crypto market. That is the bottom line. No questions asked. That's what's going to drive the price of not only not only Bitcoin, but of everything back up. So the reason why it's the price is not doing anything is because there's not more people coming in. More importantly, there's not more dollars. There's not more US dollars or fiat moving and converting into crypto. Thus, the price, the supply and demand point of crossing does not go up. So we're watching that. You're seeing that across the entire market itself. So as you scroll through, you may see things here and there that are bouncing. You're going to go into any chat room and you're going to see people talking about the one coin that moved a lot. This is when you start to see a lot of people start to come up with tantalizing offers to show you how to seek out those gains, because it is an addictive thing. But again, this is just one of these wait and see situations. And really what it comes down to is what are the forces that are going to drive massive volume, right? And one of the easiest story to tell, and it's true in many ways, is that the volume is going to come from these big institution, bankers, pensions, funds, whatever, that are going to come over, and they are going to just dump a lot of money into crypto. And that it's like that is true to a certain extent, but you also have to have they have to do it for a reason, right? There's got to be an impetus for it to happen. And typically incentives are much more better proxies than beliefs. Meaning a pension manager who's managing, let's say, $1 trillion in pension funds is not going to drop a couple $100 million into crypto because they think crypto is going to go up. They believe in blockchain or anything. They're going to do it because it's a better portfolio yield than their current portfolio breakdown, right? For both tax reasons, for risk aversion, for potential growth. But it always comes down to financial incentives and correlations or discorrelations, if that's a word, or non-correlated assets that they could prove will make their portfolios and their returns what they want. Meaning, as we look at the global economy, look at the global financial markets, this is what we need to be looking at. We need to look at what is happening in the global world, or in the global, the currencies, the equities, derivatives, everything. that is going to incentivize volume to come over here. Because as it stands, if it's just about price in crypto, that is not a strong enough reason. That is only a strong enough reason to get people who are like, hey, I'll go sign up for Coinbase and I'll go chase 10x returns. But that's not enough to sustain a market forever, because it has to be growing. It has to have new things, right? That's what capitalism is. And so for the price of crypto, for everything to go up, it's not only about the draw anymore. There has to be a pushing force. There has to be some macro thing that pushes money into crypto as opposed to attracting money because of the sexiness of it, for lack of a better term. And we're starting to see a few things start to unfold. If you don't know much about global macro, it's totally fine. This is a chart that compares the price of gold, an ounce of gold, to the US dollar as it is compared to a basket of index funds. If you want to look this up yourself, DXY is the ticker on TradingView for the US dollar basket, which can be seen in the orange. And then gold, which is XAU USD, is the price of gold per ounce. And I'm on the 1 day. I'm just going to move this over. I'm going to move myself over here so you can see this a little bit better. I'll move myself down. All right, but you can see here, traditionally, gold has a relatively inverted correlation with the price of the dollar. And I would say, actually, it's inverted to the health of the economy, because it is considered to be a flight to safety. So if you have gold, it's widely considered to be a hedge against growth assets as they're going down. So if you have gold, it tends to go up. As everything else goes down, it balances out your portfolio. So what we're seeing is that right now, the equities market in the U.S. is going up, like the stocks and everything. I mean, it's on one of the craziest bull runs in history. But we are seeing, I think 2018, this month is one of the steepest declines in the value of the US dollar ever, at least in the last, 20, 30 years almost, like back to the late 80s when, we had a really serious inflationary cycle. You can see that on this orange line right here. So as the dollar loses buying power, really, in the global world, you're seeing the gold price increase, right? That's not a coincidence. That is how it works. And you can see this inverted relationship actually is pretty clear over this is a daily, so we're looking at the last few years. So as gold is increasing, it's showing the US dollar is getting less effective. The reason why I'm using US dollar is just because that's typically the benchmark we use. It's the biggest currency, the most established currency in the world. And so this is a very interesting macro trend. And you can do the technical analysis on this to show that, right? It's kind of like, it's funny when you come over here and you can see that there's a clear resistance point right here. If there's a breakout, even though this moves way slower than crypto, it's going to behave the same way, right? It's just going to take a little bit longer because the economy is so much bigger. So what does this mean for you? Well, from a macro standpoint, this means that if this continues, these banks, these pension funds, everybody who has these massive accounts and portfolios, this is a huge issue. One, holding cash becomes really expensive, right? Because it loses its buying power. So they're actually losing money by holding cash. Secondly, they are looking at gold and realizing that gold is increasing. So they're going to start to move over to gold. As this starts to unfold even further, that is when they may start to look at whether it be Bitcoin, whether it be a basket of crypto funds, whether it be, it can't really get much beyond Bitcoin and Ethereum because the markets just aren't big enough to handle a whole lot. But even a fraction of a percentage for some of these can be $50 million. But this macro force is what's going to cause people in those positions, decision makers, to start to consider buying crypto just as much as we are in it. We are in it because we believe that crypto, technology and the social revolution of it all, we believe that this is an appreciating asset and that it's going to go to, let's say, 50 or 100,000 Bitcoin US dollars price. So we are starting to see the beginning of the pushing force. All right. Now, again, this is not written in stone because this has never been in a situation. Remember that Bitcoin, which is pretty much the birth of crypto, was released in 2008, right? Like the white paper was 2007, 2008 was on the white paper. And since then, it's been one of the biggest bull runs in the global economy ever, right? Like 2008, it crashed, and then it's just been pretty much straight up ever since, loosely speaking. So crypto has never really seen a big global bear market. So we don't know how crypto is going to be affected by a bad economy, because right now no one's had to make a decision on where they put their assets. Relatively speaking, crypto has always kind of been a speculative play, but this could change the game. All right. Now you throw this, US dollar, gold prices, you throw this against an equities market and a bonds market. Bonds are kind of in their own world right now, but equities start to go down. Yield starts to drop. That's when this is going to get really interesting. So this is going to happen over the course of the next year, 2 years, 3 years even. But this is the kind of stuff that you go into a meeting at Goldman Sachs, Morgan Stanley or whatever. This is the kind of thing that's going to get them to move hundreds of millions of dollars into crypto. The fear of missing out, the idea that crypto could go to $50,000 or Bitcoin go to $50,000, that is not going to move the needle. This will, right? Pain of losing money and having to reallocate is very, very powerful. And that's what's going to really move it. So, or at least that's my opinion. I mean, who knows? So keep that in mind as you are building out your portfolio. The reason why is that as you start to look at your portfolio, you got to realize that's what the next huge macro thing is going to be. It's going to be a shift in the global economy yield cycle, and then that money is going to move into crypto. All of these altcoins, for the most part, it's very little to do with the product or even the price. It's just that it's very hard to correlate these assets with anything in a macro standpoint. Thus, it will not receive nearly as much of the actual dollars that the bigger coins get. That's why I'm very bullish on the top 20 or 30 coins, way more than I am about a lot of the altcoins over the long term, because that's how the money's going to trickle down. So just keeping this, you got to keep this in mind. We live in a news and an information and a community bubble, but the financial world is not. We are slowly going to be integrated into the macro world of portfolio management and everything else. And as that happens, and crypto is put on the same balance sheet as something like gold or silver or even, equities or bonds or derivatives, there is very little room for BS. There is very little room for small, low value stuff. So owning the top coins, I cannot stress this enough. It may not be sexy right now. You may not make as much money if you own Bitcoin, Ethereum, Stellar, in my opinion, Litecoin, or whatever else. I mean, you can own whatever you want. But over the long term, the macro forces are going to move into the assets that can handle it and that are justifiable in that sense. All right. So I think it's just good to keep this in mind. We get so sucked into these worlds that keeping this in mind, and this is all happening relatively speaking, relatively quickly, right? The Davos conference is right now, the World Economic Forum. That's where this conversation is starting to come out, and it's almost taboo to talk about the weak dollar or inflationary dollar, because America likes to talk about how the economy is doing so well And a weak dollar, some people argue that inflation can be stimulatory. Some people argue that it's actually very bad for the, like deleveraging cycle or whatever you want to call it. But that's up for debate. So keep this in mind. I'll link a few articles in here that you can check out. But this is the kind of stuff that can really move the needle. This can move it up, down, and more importantly, it can get the volume and the attention of people over to crypto. These are the questions. These are the things that can make or break the market and in your portfolio faster than you think. Okay, now along those lines, I thought this was a really good tweet. Bruce Fenton, if you don't know, he's kind of an OG. He's on the blockchain. What do you call it? I mean, the Bitcoin, the nonprofit, like the forum, the blockchain stuff. Super good dude, smart guy. I've been following him for a while, and watching his videos and stuff like that. He had a really great tweet. So I'm going to read this out loud for anybody listening on the podcast. So make 1,000 tokens. Keep 700 and give one to the first 300 people who ask. Then buy 10 tokens back and $10 each. You've spent $100. The token market cap is $10,000, and you made $7,000 on paper from a $100 investment. Add money, hype, FOMO, greed, marketing, multiply that by 10,000. That's many ICOs. And then he goes on to describe how this can go down. So let me explain this let me try to boil this down for a little bit, because that's a lot of info. If you had 100 tokens and you only sold 5 of them, and then you bought them back, there's a buy and a sell exchange, that would create a price, right? Supply and demand. So only 5 of your 100 tokens actually had a market price, but that market price was applied to that coin. On paper, you'd go over to or coin market cap or whatever it may be, and you would say, hey, look, these 5 tokens traded at that price. So obviously the other 100 are all that's the market rate for these 100 coins. Thus, this whole ocean of coins is worth 100 times price. There's your market cap. And the crazy part is when you use a very small piece, supply of your overall market cap, and the velocity is relatively low, it's not like a liquid, and it's controllable, right? Like you can go and buy and sell the price and move it however you want. That gets really, really sketchy, which is kind of an indictment on what these market caps are. And if you go to On-Chain FX, they do what the market cap would be if the full supply was at the current price, which gives you a different view. And that only does the top 60 coins, so I don't use it very much. But the point remains for market cap, as you are looking at market cap, realize that a lot of this is what drives a lot of market cap, right? So let's just pick on, I don't know, Syscoin. I don't own any Syscoin. I have nothing against Syscoin. I'm just picking it as a random example. But $334 million market cap right now. And let's just click on this. And max supply is 888 million. Right now it's 530 circulating in supply. We do not know how many are necessarily being locked up. You can look at liquidity on the markets and you can see how many are actually exchanging hands. But let's say on any given day, so let's say ballpark, there's $3 million worth of Syscoin trading every single day. Okay? So think about that. There's $3 million on a $330 million market cap coin, which is not the full supply. So that would actually be more like a 500 million. So $500 million market cap coin that's driven by a price that is only on $3 million worth of volume. That's like a 150x multiplier. Some people call that a PE ratio, whatever there's different ways. Not a PE ratio, I shouldn't say that. It's the multiplier that you see from between the market cap and the volume that's being priced in. But that's what's happening, right? So you can potentially have a coin that has $250,000 market cap. But if it's only being traded 500,000 coins a day, someone could be making that price up and driving the market cap. This is a really important point. Now, I don't like that he picked on just ICOs, and ICOs really just refers to new coins because ICOs are just a fundraising mechanism. But what I do like is that this is a very, very important piece of the puzzle to remember, is that how much of the supply could actually get fed by a demand, right? So if you go up to, let's say, Ethereum, and the market cap is 100 billion, give or take, and you look at the markets, and you look at how much, I don't know how much volume that is. Let's say it's $2 or $3 billion in daily volume, right? How likely is it that the price could be affected by a few people changing that? How much could the market cap go down as you make your decisions on pricing and value investing? That's really what it comes down to, is speculation versus value investing. At some point, they need to meet in the middle. And I think a lot of people believe that they look at market cap way too much for both good and bad reasons. They're like, oh man, this is Qtum, it's only 3 billion. Like, I could easily go to 30. I could 10x that. And you're like, well, that's one way to look at it, because relative market cap is important. But that's a speculator's way of looking at it, versus Qtum asking, all right, how is $3 billion? How is that value come to from supply and demand? And more importantly, how is the trading activity justifying that on a daily basis, right? What's the product doing that's going to have that level of demand support as the price goes down or up, the way that it does in traditional markets? So does this mean that everything is overvalued? Not necessarily. There's no real way to justify, to measure network capitalism yet. There's people that try to do it, but it's kind of a gray science. But this is a very, very, very important piece of the puzzle, right? I mean, think about how many people said, oh, if Bitcoin drops 50%, we were at 19,000, people were like, oh man, if Bitcoin drops 50%, I'm going to buy so much, right? Everybody would have said that. Guess what? It dropped 50%. And yeah, we had a good amount of people, but I bet a lot of people were like, oh man, is this going to keep going down? Like, maybe I should sell, not buy, right? Things change. And that's a huge piece of this type of thinking. So I think this is super, super important as you're looking at price, as you're looking at market cap, keeping this in mind as we're looking through this stuff. And lastly, there's someone named Anand who paraphrased Naval Ravikant, who did a live Periscope, which was awesome. I would recommend go and check it out. And he gives, just kind of like a snapshot of what he got out of it. This was a quote that I thought was really helpful. Hard work is overrated. Judgment is underrated, especially in the age of leverage. Picking the direction you're heading is more important than the force you apply. This is super relevant to crypto, and Naval's very bullish on cryptocurrency as a technology. I think he has his own opinions on the pricing and the current state of crypto, but I'm not going to put words in his mouth. But he does talk a lot about things like leverage, about how it's really good to build up leverage. And you can do that by building your own brand, by giving away value, by creating products, building things, whatever, that you can then put into ecosystems, put into networks, put into markets, and then let those markets or that momentum, that audience do the work, right? As opposed to you having to build the demand yourself. That's kind of one of the beauties of the internet and of emerging markets, and put those two together, technology. I thought this was really interesting because one of the themes that I've learned over the last, I guess, couple of years of being in cryptocurrency, and the last year as being pretty active in cryptocurrency, is that there is no correlation between how hard you work and how much effort you put into crypto and how much money you'll make. The only correlation I have found is how much energy you put into making good decisions that then lead to one or two clicks of the button and applying your strategy, right? It's like dropping something into a raging river or onto a freeway or some moving thing, and being able to drop it at the exact right moment, or at least have it in the right time, and have it let the greater thing do its thing, as opposed to trying to create your own momentum, as trying to create your own river. And this, I think, is so powerful. And I think a lot of people want the shortcut. They're like, and I'm sure I'm gonna get comments from people who be like, okay, that's cool, but what do I pick? How do I make the judgment call? What do I do? And that's the game. Like that's what this is all about, right? Building your own judgment, creating your own leverage, putting it into the world, into the ecosystem, and then riding that leverage. It's really, really powerful, right? That's really what investing is all about. And in speculative investing, it's definitely what it's all about. So I'll link to this. Huge thanks to Anand for summarizing, and also huge thanks for Naval for thinking the way he does. But I'll post this. I think this is a really good reminder that hustle has a very small place in speculative investing, whereas judgment has a huge place, and those often get confused, and that can have catastrophic effects. All right, so we'll leave it with that. A lot of macro today, a lot of economics today, but I love this stuff. It's great. And in the meantime, I'm going to sit back and work on making better decisions myself. So hope you all have a great day. I will catch you later. Peace out.